For 10 years, they told you it was rat poison. They told you it was for criminals and money launderers. They used the full weight of the federal government to stop you from buying it safely. But the moment they were ready to buy it themselves, the rules changed overnight. The game was never about protecting you. It was about keeping the price low until Wall Street could get in. I am Tom, and this is The Wealth Collapse. Subscribe now to stay ahead of the curve, because when the history books are written, you will want to be one of the few who saw it coming. For over a decade, the narrative coming from the highest levels of the financial establishment was unanimous. Bitcoin was dangerous. It was volatile. It was a tool for the dark web and illicit finance. From the halls of the Securities and Exchange Commission to the boardrooms of JPMorgan and BlackRock, the message was clear. Stay away. They told retail investors that they were protecting them. They claimed that the market was too manipulated and too immature for a regulated financial product. Every time a company tried to launch a Spot Bitcoin ETF, a product that would allow regular people to buy Bitcoin easily through their retirement accounts, the SEC said no. They rejected applications from the Winklevoss twins. They rejected VanEck. They rejected Fidelity. They rejected everyone. They cited concerns about market manipulation and the lack of surveillance sharing agreements. They built a regulatory wall around the asset class that made it difficult for anyone but the most tech-savvy early adopters to enter. This went on year after year. But while they were publicly denouncing the asset class, something strange was happening in the background. The same regulators who said the Bitcoin market was too dangerous to touch approved a Bitcoin futures ETF. This was a critical moment that revealed the hypocrisy of the system. A futures ETF does not hold real Bitcoin. It holds paper contracts, betting on the price of Bitcoin. It is a product that is infinitely easier to manipulate than the spot market. It is a product that allows big banks to short the asset and suppress the price without ever owning the underlying commodity. By approving the paper market while banning the spot market, the regulators created a specific market structure. They allowed Wall Street to bet on the price volatility without soaking up the supply. This kept the price suppressed. It prevented the massive supply shock that comes when billions of dollars chase a finite amount of digital gold. For years, the crypto community screamed that this was illogical. They argued that if the futures market was safe enough for investors, then the spot market, which is backed by the actual asset, must be even safer. But the SEC refused to budge. They kept the gate closed. To the average observer, it looked like incompetence or extreme caution. But to those who understand how financial cartels operate, it looked like a delay tactic. The institutions were not ready. They did not have their custody solutions in place. They did not have their trading desks built. If the ETF had been approved in 2017 or 2020, the price of Bitcoin would have skyrocketed before BlackRock and Vanguard had a chance to build their positions. The retail public would have front-run the institutions. The wealth transfer would have gone from the bottom up. The regulators could not allow that. They needed time to build the infrastructure that would allow the wealth transfer to go from the top down. So they stalled. They issued warnings. They sued innovators. They created a climate of fear and uncertainty that kept the price volatile and the public skeptical. They were buying time. And in the world of finance, time is the most valuable asset of all. While the regulators were holding the gate closed, a coordinated effort was underway to destroy the existing bridges between the crypto world and the traditional banking system. This phase of the operation is often referred to by industry insiders as Operation Chokepoint 2.0. The goal was simple. If you cannot ban Bitcoin directly, you can make it impossible for companies to touch it. You can cut off the fiat on ramps and off-ramps. In 2022 and 2023, we witnessed a targeted dismantling of the banks that served the crypto industry. Silvergate Bank, Signature Bank, Silicon Valley Bank. These were the institutions that provided the plumbing for the crypto economy. They allowed exchanges to operate. They allowed payroll to be met. They allowed liquidity to flow. And one by one, they were taken down. The official narrative was that these banks failed due to mismanagement or the risks of the crypto sector. But the timing and the execution suggest a different story. In the case of Signature Bank, regulators seized the bank, even though it was solvent. They forced it to close and sold off its assets, but they explicitly required the buyer to divest the crypto business. It was a targeted assassination of a financial service. At the same time, the SEC launched an aggressive campaign of enforcement by regulation against the major exchanges. They sued Coinbase. They sued Binance. They issued Wells notices to practically every major player in the space. They declared that almost every token was a security. They created an environment where it was legally dangerous to operate a crypto business in the United States. The strategy achieved two things. First, it crushed the price. The relentless negative news cycle and the fear of a total banking ban drove Bitcoin down to $16,000 in late 2022. It flushed out the leverage. It forced retail investors to panic sell at a loss. It created the perfect accumulation zone. Second, and more importantly, it cleared the board. By attacking Coinbase and Binance, and by shutting down the crypto-friendly banks, the regulators were destroying the competition. They were weakening the native crypto companies that had built the industry from scratch. They were ensuring that when the gates finally opened, the only entities strong enough to walk through them would be the incumbents. If Coinbase is tied up in court for years fighting for its life, it cannot compete effectively. If Binance is forced out of the Western markets, it leaves a vacuum. Who fills that vacuum? The entities that have deep relationships with the regulators, the entities that employ former central bankers and treasury officials, the entities that are too big to fail. The destruction of the crypto-native ecosystem was not an accident. It was a controlled demolition designed to clear the site for the new landlords. The message was clear. Crypto is here to stay, but the people who built it are not allowed to run it. The torch was being forcibly passed from the innovators to the aggregators, from the coders to the bankers. The Wild West was being tamed not for the benefit of the settlers, but for the benefit of the railroad tycoons who were coming to lay down the tracks. The turning point came in June of 2023. After years of calling Bitcoin a fraud and an index of money laundering, Larry Fink, the CEO of BlackRock, filed an application for a spot Bitcoin ETF. This was the signal. BlackRock is the largest asset manager in the world. They manage $10 trillion. They are effectively a fourth branch of the government. They do not file for ETFs unless they know they will be approved. Their record of approval with the SEC is nearly perfect. The filing was a shock to the market. Only months earlier, the narrative was that crypto was dead. FTX had collapsed. The regulators were on the warpath. The price was stagnant. And suddenly, the king of Wall Street walked into the room and put his chips on the table. Almost immediately, the narrative shifted. The same media outlets that had been printing obituaries for Bitcoin started talking about its institutional legitimacy. Larry Fink went on television and called Bitcoin a flight to quality and an international asset. This is the same man who, in 2017, called it an index of money laundering. What changed? Did the technology change? No. Did Bitcoin become less volatile? No. What changed was their position. They were ready. They had built the custody partnerships. They had set up the trading desks. They had suppressed the price long enough to accumulate a starting position. The conspiracy of convenience was over. The accumulation phase was beginning. Following BlackRock, every major financial institution filed their own application. Fidelity, Franklin Templeton, Van Eck. The floodgates opened. The SEC, which had fought these applications for a decade, suddenly found itself cornered. They had run out of excuses. A court ruling regarding grayscale had backed them into a legal corner, but the BlackRock filing was the political checkmate. The approval in January 2024 was a coronation. It marked the official merger of the crypto asset class with the traditional financial system. But it also marked the end of the early adopter era. The mechanics of the ETF are crucial to understand. When you buy shares of a Bitcoin ETF, you are not buying Bitcoin. You are buying a receipt that represents Bitcoin held in a vault by a custodian. For the vast majority of these ETFs, that custodian is Coinbase, but the ultimate control lies with the issuer. This creates a massive centralization of supply. As billions of dollars flow into these ETFs, BlackRock and Fidelity become the largest holders of Bitcoin in the world. They become the whales. This changes the market structure. It dampens volatility, which sounds good, but it also dampens the revolutionary potential of the asset. When Wall Street owns the float, they control the price action. They can lend out the Bitcoin to short sellers. They can create paper derivatives on top of the real assets. They can rehypothecate. They can do all the things they did to the gold market. The gold market has been manipulated for decades because the paper gold market dwarfs the physical gold market. The price of gold is determined in London and New York by trading unallocated contracts, not by the physical exchange of metal. This is the playbook they are running on Bitcoin. They want to turn it into another financial asset that sits on their balance sheet, generating fees, rather than a tool for monetary freedom that undermines their power. The pivot from enemy to owner was not a change of heart. It was a change of strategy. They realized they could not kill it, so they decided to financialize it. This brings us to the end game, the Trojan Horse. The Bitcoin ETF is sold as a vehicle for adoption. It brings number go-up technology to the masses. It allows your grandmother to buy Bitcoin. It allows pension funds to allocate 1% of their portfolio to digital assets. This will undoubtedly drive the price higher. We will see numbers that seem impossible today. But the cost of this adoption is the capture of the protocol. The mantra of Bitcoin has always been, not your keys, not your coins. It was a declaration of independence. It meant that you did not need a bank to hold your wealth. You did not need permission to spend your money. You were the sovereign of your own assets. The ETF model destroys this. When you hold an ETF, you are a creditor to BlackRock. You do not own the keys. You cannot sign a transaction. You cannot move your wealth across a border in your head. You're back in the banking system. You are subject to their hours, their fees, and their censorship. If the government orders BlackRock to freeze the assets of a certain group of people, BlackRock will comply. If the government decides to confiscate Bitcoin as they confiscated gold in 1933, they will not come to your house to find your hardware wallet. That is too hard. They will simply call the CEO of Coinbase and the CEO of BlackRock and order them to hand over the keys to the custodial vaults. In one afternoon, they could seize millions of Bitcoin. Furthermore, there is the risk to the consensus mechanism itself. Bitcoin is governed by nodes and miners. But if a handful of institutions hold the majority of the coins, they gain outsized influence over the future development of the network. In the event of a contentious hard fork, a war over the rules of the protocol, the entity with the most coins has a massive vote. If BlackRock and Fidelity decide they want a version of Bitcoin that is compliant with ESG standards, or that allows for transaction censorship, they can use their massive holdings to push the market in that direction. They can create a corporate version of Bitcoin that trades at a premium while the free version is marginalized. This is the custody trap. They are luring investors in with the promise of easy gains and tax advantages. They are making it convenient. But convenience is the enemy of security. By centralizing the supply of Bitcoin into a few massive honeypots, they are recreating the very systemic risks that Bitcoin was designed to solve. They are turning a decentralized peer-to-peer cash system into a centralized settlement layer for interbank transfers. They are trying to turn Bitcoin into just another asset class, like real estate or bonds, that they can charge you a fee to hold. So what is the solution? It is simple, but it requires effort. It requires resisting the siren song of the ETF. If you believe in the revolutionary potential of Bitcoin, you must hold your own keys. You must educate yourself on self-custody. You must support the decentralized infrastructure that still exists. The ETF is fine for the speculators and the tourists. But for those who see Bitcoin as a lifeboat in a collapsing financial system, the ETF is a trap. Do not let them sell you a paper receipt for freedom. Own the real thing. Because when the crisis comes and the banks close their doors, the only thing that will matter is who holds the private keys. The institutions have made their move. They have breached the walls. But the war for the soul of money is far from over. It is just beginning. And the most powerful weapon you have is your ability to take your wealth off their table and hold it in your own hands.